Hi, this is Rahul Sharma here from JM Financial. Welcome to the Horizon video scene. Well, Budget 2024 is just done and markets have given it a salute, hitting almost a new all-time high in today's session. What is it in store for us? Well, one thing that we liked from the budget perspective is there were no populist measures given in this budget, given especially the election backdrop. Secondly, the markets went into this budget with low expectations. So if we rewind a bit, around 3 to 4 weeks back, market got into this consolidation / time correction. What that ensured is there was a sectoral shift. We saw banking taking the pain after the HDFC Bank results, but at the same time we saw Reliance come out of the woods and scale new highs. That ensured that Nifty stayed afloat in spite of the sell-off that we saw in the banking and financial space. Well, fast forward today, Nifty is at 22,000 and now looking and asking what next. Well, let us look at the technical texture of the market as to what February has in store for us. Well, looking at the movement, looking at this current consolidation, the attempt about 22,000 should see us heading northwards, and it would be unfair to put a number target on the Nifty index in terms of how much can we achieve. But the direction seems north as long as we sustain above it. Now, we have been saying that there has not been a significant correction in this entire rally, but the good thing is last 1 month has seen some time correction in the Nifty, which strengthens the case for the technical setup of the market. Well, not only that, we are also seeing the broader market which is resilient than ever. So talking in terms of Nifty, the key support levels for the Nifty now shift to 21,800 as an immediate support and 20,127 as a crucial bottom low that we had formed in this correction. Well, as long as we remain above the 21,800 mark, bulls should be in charge, and about 22,000 we should see the Nifty head towards 22,500 and above. Now, the bigger picture or the deeper insight is in the broader markets, which is more represented or better represented by the Nifty 500 index. As you can see in this graph, this is the ratio chart of the Nifty 500 index, which is the broad market indicator, divided by the Nifty 50 index. Now, if we look at the history, the entire history of these two indices, this ratio is at the cusp of a big breakout. Well, this is the third attempt to take this resistance out, and this resistance of 0.92 odd, once taken out, should see a big upside happening in the small and mid cap space. Now, that does not mean that corrections will not come. Timely corrections may keep on happening, but we can safely say that after this recent cooling off, we can at least expect another 3 to 4 months of strong rally in the mid and small cap space. Now, this ratio is indicating that both Nifty as well as the broader markets should continue to do well. Now, let us go a step further and identify which are the pockets of the market where there is a bit of a challenge in terms of markets moving up. Now, clearly the private banking index has been under pressure. If we see the charts of HDFC Bank, if we see the charts of Axis Bank, Kotak Bank, ICICI Bank, they have underperformed the broader market. In the banking space, it is clearly a fight between the PSU banks on one side, which are extremely strong. In fact, the index is hitting newer highs as we speak. And on the other side, we have the private banking index, which is struggling to say the least. Now, PSU banks have come out of a long-term underperformance with respect to private banks. Now, as you can see in this ratio chart, this is more than a decade of underperformance that was seen by PSU bank names, which has now started converting into outperformance. So this outperformance should now continue, and we may very well see the rest of 2024 being dominated by the PSU names. So we continue to remain bullish in the PSU banking pack. Timely corrections will come. These corrections are to be bought into. 15 to 20% correction in stocks and about 8 to 10% correction in the index would be healthy re-entry points. But as an investor, it would be prudent to stay invested in a sector which has come out after years and years of underperformance. Now, The public sector enterprise or a PSE index is something that we had highlighted around 12 months back. Now, the year 2023 completely was dominated by the public sector enterprises. Even this year, we are seeing the PSE stocks doing extremely well around the budget. It is having the time of its life. Now, till when does this party continue? It could be anybody's guess. But the best thing to do is party close to the door. So as far as the public sector enterprises are concerned, keep booking profits wherever you are getting good returns. And at the same time, if you are a trader, it is best to stay close to the door in case a reversal happens. This is one of those indices where we advise booking profits at regular intervals. Now coming to the IT space. Now IT is something which has sort of remained subdued for the past 18 odd months. But especially in the last 3 months, we've seen traction happening in this space. Now, looking at the monthly chart of the IT index, this is a clear rounding bottom that has been formed after this underperformance. And now we feel that the index is ready to change gears. The heavyweights like Infosys, TCS, Tech Mahindra, HCL Tech, all of them are poised well for more upside. At the same time, even the mid-cap IT names, although they have seen correction in bits and pieces, but overall the higher high, higher low setup on the long-term charts is pretty much intact, which means that IT indices could continue to do well and IT stocks could continue to outperform in the near term. So IT as a sector looks good. If there are any correction, this is the space to go for. And even as a defensive, this should play well given the overall overheated texture of the market. Now, pharma is something that has gone into seventh heaven. The pharma index doing extremely well, both on the monthly as well as the weekly time frames. It is not as overbought as it was in the past, which means more upside can be possible in the pharma index. So pharma continues to remain very, very strong on the long-term charts at the index level. And individual components which have corrected or relative setups which are looking, there are a lot of relative setups which are looking very good at these levels, can be looked upon for the long side. So pharma is one space where we feel that the outperformance could continue over the next few months. And this is one of those cyclical plays which sees cyclical movement just like the metal index has been witnessing. So we continue to remain positive on the pharma space as well. At the same time, if the broader market does get a bit edgy, this is again works as a defensive play, and we've seen time and again whenever Nifty has been consolidating or correcting, we've seen pharma as a defensive pack come into play and these stocks do well. Now coming to another cyclical index, which is the metal index. Metal index is again doing extremely well, but it is at a make or break point level. Now if you can see this graph, it is a pattern which is essentially a reversal pattern. It's called a rising wedge. And if this wedge does get through, which is the breakdown does happen, the lower trend line does get broken, we could see a sharp fall in this. But at this point in time, it is not confirmed, and the sector continues to be very strong, very robust, led by the likes of Steel Authority of India, which is right there on the top of our buying list. Then we have Tata Steel, Hindalco, all of them doing well. So the individual components still are not as overbought as probably the index is, which is sum of parts. But at the same time, if this rising wedge does get navigated or does get negated, we can see a decisive trending action coming into the metal index as well. So at this point in time, one can keep fingers crossed, but at the same time, individual stock components continue to look attractive on the charts on the near term and short term time scale. Auto index is overheated on the daily charts. We are witnessing signs of exhaustion. We are witnessing bearish divergence on the daily charts, which means a bit of correction is around the corner. So if you are holding stocks in this space, it is advisable to take profits. If you recollect, we have had Tata Motors as our Diwali pick, which has done extremely well. All the targets have been met. We advise booking profits in the same, and overall the sector also looks due for a correction. So look to book profits in this space. We post a correction, this sector can again become attractive. But at this point in time, it is advisable to be cautious and take some money off the table. Now coming to the currency and commodity part. So equity so far seems like we have had a good time and the good time may continue. But on the currency side, there are some developments which are worth noting. Like for example, the USD INR pair, we've seen almost a breakdown in the USD INR setup, which means the rupee is strengthening. And if this trend continues, so the 200-day EMA for the USD INR is very close by. If that gets broken, we may see further strength in the rupee, which means the current chart structure can become more and more bearish. So it is at a make or break juncture. Again, in the past also we've seen this currency pair bouncing back very sharply from the 200-day EMA. Somewhere in August last year we saw this happening. If this time around also there is a bounce back, keep your eyes and ears open for a possible sharp up move in the same. So it is not as easy as probably trading equities at this point in time, but at the same time, if you are an option writer or if you are trading into options, this is a good time to be, this is a good pair to be in, and you can very well seek help from our currency and commodity desk for any trading strategy in the same. Coming to oil, which has been the focus, especially given the geopolitical scenario that is developing between US and Iran. Now, clearly on the charts, it is suggesting that the downside is done and the oil may see a bounce back happening from these levels. Sooner than later, we should see oil heading towards the $90 per barrel mark or maybe even higher. Now, if the geopolitical situation does deteriorate, we expect this to go even higher and faster. And at the same time, that could involve a bit of breaks on the equity markets as well. So crude oil remains a bit of a concern, especially for the equity markets, but individual setup of oil as a trader looks very good, and there could be a high possible at any point in time. So our view in oil continues to be positive. Gold has been consolidating broadly in a range, trading above its key moving averages. So the trend in gold remains positive, and it is one of those rare instances where we've seen equities and gold both do equally well. Although the quantum of performance in equity is far better, but we feel that there is a new high possibility in gold. The outlook remains positive in gold as well. So to sum it up, February should be a good month in terms of the equity markets. There are risks, of course, if there is any geopolitical escalation that would cause the markets to pull back. But as long as there is no major change in the macro fundamentals or the technical setup of the market, we feel Nifty to head north of 22,000. The direction remains up. 22,500 is something that we're expecting on an immediate basis. And sectorally, we feel that there is more upside to be had in PSU Banks. There is more upside to be had in IT. And as a defensive, pharma and metals could continue to do well. So I hope you have a profitable month ahead. Thank you for listening to this video and have a good time ahead.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.